Welcome to Market News International's August webinar, Latin America Policy Changes and Challenges. I'm Lauren Hand, the Marketing Manager for M&I. And today, I'll give a brief overview of what we do here at Market News International. And then Heather Scott, our featured reporter, will speak for about 15 minutes addressing how the major Latin America economies are trying to deal with currency appreciation and inflation pressures. We'll follow all that with a question and answer session. So if you have a question at any point during the presentation, you can address it to Heather directly by using the chat function on the right-hand side of your screen. And we will get to all of your questions, time permitting. So you can also email Heather with your questions after the webinar. And you can email me for a recording of today's presentation, and we'll have our contact information available at the end of this webinar. A little bit about us. Market News International is a subsidiary of the Deutsche Börse Group and the leading provider of news and analysis specifically for the global foreign exchange and fixed income markets. We are 4 real-time English-language financial news agencies with press credentials recognized by governments and central banks of all major economies. For exclusive monetary and fiscal policy reports, economic indicators and forecasts, and market-moving interviews with key central bank and finance ministry officials, government policymakers, and economists. Our desks are located throughout 12 news bureaus across Europe, America, and Asia, of which are former fixed income and currency traders and strategists. And today's featured reporter is Heather Scott. And Heather is our Washington, D.C. Deputy Bureau Chief of International News. She created and coordinates M&I's coverage of the major economies in Latin America. Heather joined M&I in 1996, and after building a network of reporters in the region, she pioneered the LATAM Watch report, which is published every Monday, previewing upcoming top developments in Mexico, Brazil, and Argentina. Heather is a graduate of Virginia Tech and holds BA degrees in both Spanish and journalism and minors in history and biology. And with that, I will turn our presentation over to the expert. You can take it away, Heather.
Thanks, and welcome everybody to the webinar this month. I'm happy to be here, and I hope this will be of some use to everyone. The global financial crisis has created a situation that is somewhat unprecedented in modern history, as the emerging markets, including the Latin American economies, not only didn't succumb to the crisis that was created in the advanced economies, became I was had a problem there. The American economies not only didn't succumb to the crisis that was created in the advanced economies, but in fact became an engine of global growth, which credited with preventing another Great Depression. The aftermath of the crisis also created something that was unprecedented because these countries then had to sort of face the challenges that was brought on by their success. Policymakers, however, have reacted with caution and very good judgment, raising interest rates to tamp down growth and reacting to cool the inflationary pressures before the economy got sort of too bubbly. They've also been building up reserves while allowing their currencies to appreciate, although there has been some sort of moderate intervention in the currency markets to sort of smooth out the worst of the fluctuations in the market. In addition, these governments have largely, which is another sort of unprecedented feature, maintained fiscal discipline, unlike what they've had in the past, where they tended to have a sort of runaway spending. They even introduced budget cuts and have gradually reduced their debt levels. This year in particular, and in the end of last year, there have been some fears of a bubble economy. Those fears have largely receded, due to the policy responses, but also due to the sort of slowdown in the international economy. And for someone who's been covering Latin America for a long time, I have to say this situation has given rise to some scenes that seem a little bit surreal to me when we see the Brazilian finance minister sort of railing against the stimulus in the United States and accusing the advanced countries of launching a currency war, and having the the Mexican central bank governor lecturing the European Union about the lack of fiscal discipline. It's quite an interesting experience if you've been covering Latin America for any amount of time. In any case, what I'd like to focus on today is how the governments have responded, how they're dealing with their current policy challenges, any policy changes that might be expected in the near future to adjust as the situation sort of evolves. Now, to those of you who are regular readers of M&I's LATAM Watch, some of this material may seem familiar because our reporters in the region are continuously seeing and analyzing these issues in the region's major economies. Not yet done, so I'd encourage you to look out for the LATAM Watch feature every Monday morning. It features our reporters Daniel Horch in Brazil and Charles Newberry in Argentina. Starting out with some background information. I don't want to spend too much time on this because it's familiar to most of you, but just to give you the setup and a little bit of background. Some information on what the situation looks like now. Little chart to show the GDP percentages. The source of this information is from the IMF's World Economic Outlook, and you can see there was in 2010 a little bit of a frothy growth, especially in Argentina. But the rating, and most of the economies in 2012 are looking more in the 4 to 5% range. Although we're expecting some of these rates to be or forecast to be revised downward. Now, inflation-wise was in pretty good shape. Sort of, especially Brazil, you can see. And Mexico is higher above the target. Both in Brazil and Mexico, you can see above the target in 2011, but at least by the IMF to hit their targets by the end of 2012. This number, this is Argentina. You can see a suspectly flat line, which we'll discuss a little bit later. You're probably familiar with the issues with the reporting of inflation in Argentina, so I won't dwell on that too long, but the figures are a little bit suspect. And this just shows a trend, sort of the debt levels are either flat or declining in most of these countries. So currencies likewise, they're appreciating, but the Mexican peso appreciating, but with the measure the governments have taken have sort of moderated the appreciation. Brazilian currency here, the real, moderated. The government is taking credit for this. And Argentina's peso, you'll see Argentina in a lot of ways is an outlier. And of course, the peso is going in a different direction from most of the other economies. Now, policy responses. Just a quick view of what they've done so far and how those steps are working. Now, Mexico, starting out with Mexico, obviously the proximity to the U.S. and the tight links between the economies has had its pluses and minuses historically for Mexico. In the last couple of years, with the U.S. downturn, has meant Mexico has had sort of fewer highs than other countries, but also fewer lows. So their growth has been solid, but not too strong. Now, because of the government's experience with crises and their policy work, as a result, even with the global crisis and the U.S. recession, we've sort of seen the converse of that old saying. So when the U.S. caught pneumonia, Mexico this time only caught a cold. The government operations, as you recall in that chart about the debt levels, government operations have been financed 2012, which eases pressure on the finance ministry issue new debt if the conditions aren't right. But the finance ministry has successfully issued 30-year and 100-year bonds. That's not a typo. 100-year bonds, reopening both of those issues. So they've clearly earned the confidence of foreign investors, and they're considering samurai bond issues possibly later this year. Monetary policy, the Bank of Mexico has kept the benchmark policy rate at 4.5% since August of 2009. They didn't, even when the growth was high, didn't see the need to raise rates to slacken the economy. It sort of offset the modest or seasonal inflation pressures and the high commodity prices. Foreign reserves are at record highs, $136 billion as of August 19th. This is all helped by an IMF credit line, gold purchases, and high oil prices sanctions, of course, which have allowed the state oil company, Pemex, to sell a lot more dollars to the bank from its higher exports. There's been a lot of direct currency intervention in Mexico. The central bank was offering $600 million in monthly put options last year, but economists are saying that the banks are not cashing in on these options because the pesos remain sort of volatile on recent trading anyway. The government has taken some steps recently to help the economy. They've expanded funding for small and medium businesses and provided some guarantees through a development bank known as Banobras to help indebted states finance their debt and for companies to finance infrastructure projects. Now, turning to Brazil, and I'm sorry if I'm going fast, I want to get through this quickly to leave time for questions, but turning to Brazil, major concern there has been the short-term capital inflows that are pushing the currency, the real. And the central bank has said that its prim to dollars is working and to counteract the effects. Now, in 2009, Brazil imposed a financial transactions tax, the IOF, of 2% foreign investment in domestic stocks and sovereign debt. In late 2010, increased the rate, the tax on fixed income to 4% and to 6%, and then expanded the purview of the tax. The government also tightened regulations on currency holdings in early July this summer. End of that month, also imposed a tax on currency derivatives of 1%. But this tax can be raised to as high as 25% without warning. So that's sort of something they have in their toolbox if they need it. Now, the interesting thing is that the market consensus is that these measures have kept the real from appreciating. And without them, they estimate that it might have reached 140 to the dollar. I think it was at 175. 6 months ago, it was at 166, and now it's about 161. Some analysts are a little suspect about what the government has called a recomposition of currency flows. They claim that it's foreign direct investment and moved away from the short-term investment. Some suspicion that is sort of hidden speculative investments, but the government insists that this policy is working. Now, the bank, to address fears of a possible reversal of these capital flows, has built up over $350 billion in reserves. And while the COPOM, the Monetary Policy Committee, has raised the benchmark SELIC interest rate 375 basis points this year to 12.5%, and to do some measures to limit consumer credit growth. I mentioned before, Argentina is a little bit of an outlier in a lot of aspects. And the President, Cristina Fernandez de Kirchner, is committed to pushing economic growth as high as possible with little or no concern of inflation. She thinks that, she's obviously running for re-election, October presidential elections, and is relying on the strong economic performance for her re-election. The economy is booming. It's grown an average of about 8% since 2003. And as all is forecast to expand by about 6 to 7% this year and 5 to 6% next year. Now, the government, another policy pillars of the Argentine government is to keep the peso as low as possible to spur exports. The central bank has been buying dollars from the exporters, especially from the soy and other agricultural commodity exporters. And the dollar bank has built up the reserves to about $50 billion. Serve as a cushion because the state is also taking their debt payments entirely out of reserve since they still don't have access to international capital markets. Now, as a result of this sort of booming economy strategy, domestic consumption is also booming. It's increased, which is increasing costs, fueling manufacturing, the retail sectors. And the government sees this as entirely positive and have repeatedly said that they won't fight inflation at the expense of growth and jobs. And on the flip side, since the central bank has become completely subservient to the finance ministry, there is no autonomous monetary policy in Argentina. So what comes next? Now, for weeks we've been watching to see what the policymakers will do to adjust to these new challenges, especially with the renewed slowdown in the U.S. and the global economies and the European debt crisis. But just in the last couple of days, there have been some announcements in Brazil and Mexico that have shed some light on this. Brazil, I'll start with Brazil this time because that was the most recent. Just yesterday, the finance ministry, after making some hints last week, Monday announced an increase in his primary surplus target for this year of 10 billion reais. She said was aimed to give the central bank room to maneuver as it sees fit to lower interest rates if the economy slows in the medium term. The new target, with 128 billion reais for the consolidated public sector, will not require budget cuts, but it will prevent the government from spending any additional revenue. And also said that, he repeated yesterday what he said last week, which is that if the Brazilian economy needs stimulus, it should rely on monetary stimulus, not fiscal stimulus. And it's the responsibility of the central government to create the conditions to allow the central bank to make the changes it sees fit. Now, the government had already announced about 50 billion reais, or $31 billion in budget cuts earlier this year. So yet another fiscal move. Now, and also a little bit skeptical about the scope of these measures because there's some spending that can't be avoided. For one thing, the public sector is going to have to ramp up its investment spending ahead of the 2014 World Cup, where Spain will defend its title, and the 2016 Summer Olympics. Obviously, there's a lot of infrastructure that goes into hosting those two big events. Now, the timing of the announcement was quite interesting because the Central Bank Monetary Policy Committee, the COPOM, will announce its latest decision tomorrow, Wednesday. But the finance minister, that was really basically just a coincidence that it was not linked. But obviously, the timing is interesting. Now, COPOM, as I mentioned before, has kept the overnight rate at 12.5%, is expected to do so again tomorrow. But more and more, the economists are changing forecasts and looking for rate cuts as early as later this year or the beginning of 2012. Now, it's a little contradictory because the consensus forecast for inflation is for almost 6.3% this year and 5.2% in 2012, which again above, as you mentioned before, above the central bank's 4.5% target for both of those years. In addition, unemployment is at a historic low of 6%. Real wages have risen 4%. Retail sales are up 13.3% in the last 12 months. So, and this tight labor market is one of the things the central bank has cited as biggest concerns in fighting inflation. But Central Bank President Tombini himself said that the slowing growth has changed the environment for monetary policy and that they will take that into account in their discussions in their announcement Wednesday. Mixed messages, and although the Brazilian performance is good, there's still these messages from the finance ministry. Manteiga, just a few days ago, again repeated his concerns about the currency war, which he revises about every couple of months. And as I said, the government will take steps to protect Brazilian companies from unfair competition. Now, this is a concern because protectionism has been one element that's been thankfully absent from this crisis. His statement sort of raises the fear of possible domino effect if they actually follow through. There's been similar noises coming out of Argentina, and if the two of them, something like that, it could be a worry. Fortunately, the government hasn't always tended to follow through on Manteiga's threats. Mexico, just Friday, was a very interesting shift in sort of the monetary policy focus. Now, for months, the Bank of Mexico has continued to repeat its commitment to being vigilant to any resurgence of inflation pressures and to adjust policy appropriately. But Friday, in its statement, there was what I thought was a dramatic shift in language. Instead of focusing on inflation pressures, it turned to focus on the international environment, which it said it had deteriorated significantly. And what I thought was the key phrase, when I said it will, adjust its policy stance to avoid any unnecessary hardening of policy. That it sort of, again, leads one to suspect that they might be thinking about time for rate cuts. Point. We did not give any indication of timing. Now, this comes at the same time as the government is revising down its growth estimates to 4%, and some private analysts have even gone below 4% from the previous range, which was kind of 4 to 5%. And on the fiscal side, the finance minister, Ernesto Cordero, who you may know is expected to run for president, has promised a highly responsible 2012 budget proposal, and we should get a look at that on around September 8th when they introduce it to Congress. Now, it's not clear if they will just a close to zero or a zero deficit target, but the government at least is committed to fiscal responsibility, to keeping the economy strong. Now in Argentina, as I said, things a little bit different. There's the main issue is the inflation and the potential overheating of the economy. That's the major threat. Now, for the last couple of years, the government inflation data has been very suspect. The official rate is reported around 11-12%, half of the 22% estimated by private forecasters, and gone to the extent of slapping fines on the private forecasters who publish their own calculations. They are supposedly working with the IMF to come up with a new inflation calculation, but that hasn't seemed to have progressed very far. Now, interest rates, less inflation, it's fueling this consumption boom. And so basically using their savings to buy assets, which range from plasma TV to real estate or just buying dollars. The result of the inflation, too, union leaders, who are big supporters of the government, have been ramping up pressure to raise wages. And the government also stepping up trade restrictions to limit imports and protect domestic industry. Any major policy changes would probably be on hold until after the October elections, which I said Cristina Fernandez de Kirchner seems likely to win in the first round. But what she decides to do after that is a big question mark. You had one suggestion she could cut subsidies on energy and transportation to help shore up the public finances, but it seems unlikely she would agree to cut or pensions. But again, another problem is the dependence on commodity exports, since there are major markets like China and Brazil are also seeing their economies slow, so that will reduce demand and in turn would eat into the fiscal surplus, which benefits from the taxes on export earnings. Now, it was likely to continue weakening. Export revenues decline and demand for dollars, increases. Resorting to again buying dollars to protect against this international uncertainty. Analysts are expecting the peso to flip to about 4.2 to the dollar by the time of the elections, 4.29 by the end of the year, and this compares to about 4.185 this week or last week, and 3.9 at the start of the year. The problem is capital flight, as I said, buying at dollars was about $12 billion estimated the first 7 months of 2011, increased to $2 billion a month since May. Currency reserves are in Argentina although at $50 billion now, and are $52 billion in 2010, are looking like they're expected to decline to $4 billion or below by the end of the year. So that is limitation. Obviously, I didn't cover the entire region. I was because I'm limitation. I just want to hit the major economies. Hopefully, it's helpful. And ready for any questions you might have. While I'm waiting for the questions to come in, turn it over to Lauren.
Thank you very much, Heather. So if you have any questions, you can enter them into the chat box on the right-hand side of your screen, and you can address your questions to Heather directly, or me, or all presenters, however you'd like to do it.
Okay, we had a couple of questions. second here while we go down.
And you can email Heather your questions after the webinar. She can be reached at hscott@marketnews.com. I'll have her contact information and her Twitter information available at the end of the presentation so that you can take it down.
Okay. Just a quick question. I got one question here about the central bank and the timing of this announcement by the finance ministry. That's sort of a disguised attempt to put pressure on the central bank. Officially, the central bank sort of reports to the finance ministry, and the central bank president serves at the discretion of the president. But in fact, Brazil is pretty much, or the central bank, the COPOM, has pretty much maintained operational autonomy and policy autonomy. So, although occasionally you hear people mention that concern about the finance minister's role in the central bank, it really, as I can tell, has never been an issue, and the central bank has always been exercised their policy autonomy, so they haven't had a lot of pressure from, although which is not, and even Montega, who likes to rail loudly against the advanced economies, has been very careful in his commentary about. He thinks the stimulus should be monetary. It's entirely up to the central bank to decide what stimulus, when it should be implemented. So he's been very careful in his wording. So I don't think that's really a concern. A question about trade with China and the importance of Latin America, and that's been a huge thing, huge factor. Even Mexico has tried to sort of branch out, although Mexico's economy is very much tied to the U.S. economy. But for example, in Brazil, Argentina, they're starting to rely much more on the Chinese economy and move away from the traditional north-south dependence. So that's has been a critical feature. Now, as pluses and minuses, obviously, because there's a little bit of happening in China as well. So with the slowdown in the Chinese economy, it's affecting exports from Latin America. So I have in front of me the breakdown by country, but I look that up and get that for you. But as you rightly point out, it's a big factor. The commodity exports, in particular, from Argentina, but it's also the imports from China to assemble products is another thing, and another feature of the Brazilian economy. So that's interesting. Now, another question was about the rapid growth of lending by development banks in Brazil. Now, I don't have on that, but and I didn't go into this because this happened a few months ago. But the question, the policy changes on credit growth. Brazil has, in fact, the central bank has, in fact, imposed some measures to sort of tamp down credit growth. That was beginning to be a problem. Now, I'm afraid I don't have, though, the data on the development banks and the growth in those, that kind of lending. But certainly the credit growth, consumer growth, was one feature that was a bit of a worry. And the Brazilian Central Bank did act to counter, sort of tamp that down a little bit. Not done anything else recently, and I haven't given an indication. We'll find out from their statement a little more and their policy minutes after this meeting. But in the last couple of policy minutes, they haven't really mentioned consumer credit growth as an issue. So something we're expecting. No. There was another one. Another question, the chances of Argentina returning to debt markets in the near future. Depends how you define near future. I mean, the thing that they have to do first, of course, is resolve the Paris Club debt with the official creditors. Have been for months that they're working on that's target. The latest thing is they're saying they want to do that by the end of this year. But I honestly don't hold a lot of hope. They're very quick. That doesn't seem to be a real focus, especially as they've got, as I said, booming economy and strong reserves, and they're not worried about inflation at the moment. I think that might, that policy, as it has in the past, might come back to haunt them. But for the time being, I mean, they're really working on getting this Paris Club debt resolved. But they, as far as I know, don't even have any meetings scheduled. Now they might. The IMF annual meetings are come up. They traditionally have some kind of meeting around that time, but with the October elections, I don't think they're doing anything in November, December, and that puts you already into 2012 before they get that resolved. So I don't think that's, I think that's something that's coming up anytime soon. And let's see. What else? Sorry, we're trying to read and talk at the same time. Question on the high oil prices helping the Mexican growth and the impact on inflation. Yes, Mexico's exports and the value of their average sort of basket of crude has skyrocketed, just like oil prices everywhere. The problem with Mexico is that their product imports, largely gasoline, have also skyrocketed. So, I think it was like a 40% year-over-year increase in July, something like that. So, the problem, their industry is sort of deteriorating and needs work. They haven't resolved this issue of private investment to, find new fields, develop offshore reserves, and improve their production. So they're caught in this place where they're having to import a lot of their gasoline. So even though they're earning more on exports, they're spending a lot of that money on gasoline imports, and of course the price of those imports are also higher. So so that's a big problem in Mexico that needs to be addressed with the Pemex. Now they have begun this sort of tentative person sharing contracts, which they've only just the contract, so it's very unclear how that's going to work out. It's been delayed. The next phase has been delayed, so we're still waiting to see how that's going to work out. I think we're running out of time, Lauren. Is that right?
Yeah, we better move on. But again, if you have a question for Heather, you can always email her. And thank you much, Heather.
I appreciate it. Thanks for joining us. I hope it was helpful. And if I didn't get to any questions, I'll try and get to those by email.
Great, thanks. So, upcoming webinar, What to Expect for Currencies and Commodities in Q4, will be by our senior foreign exchange reporter, Vicki Schmelzer, on Thursday, September 22nd at 4 p.m. Eastern Time. This webinar will focus on the outlook for currencies and select commodities for the final quarter of 2011. We'll explore which currencies will be winners and losers, where the yuan will end the year, and where gold is heading. You can register by visiting marketnews.webex.com. And as promised, I am going to leave up this slide with Heather's contact information. Again, email her with any questions about the content of the presentation. And email me for recording of today's webinar or a copy of the charts used in today's presentation. Again, I'm Lauren Hand. And you can follow us both on Twitter. Our Twitter handles are listed here. And be sure to look for us on Facebook and LinkedIn. You can actually join our financial information group on LinkedIn if you search for Market News International. And we'll keep you updated of any upcoming events or webinars that we have scheduled. Okay? Thank you very much, everyone, for joining, and we hope to see you again.